Hey guys, James here. In this video, learn how to trade crypto futures. We'll go through the basics of why you'd want to trade crypto futures, what the benefits are, and also the risks, and how to navigate a futures trading screen to place orders. Timestamps for everything are listed in the description below. There are many ways you can go ahead and trade crypto futures. I'm going to be using Binance right here, one of the largest crypto exchanges, and they do offer derivatives, as you can see. So I'm just going to click in to US dollar stablecoin futures. I'll explain what those are in a second. This is essentially the trading screen. If you don't have Binance, I'll leave a link to them in the description. You can sign up for an account, go and trade in the spot market or the futures market. The spot market is the cash market. So that is when you actually go ahead and buy cryptocurrencies. This is the spot market screen for Binance. What you can see here is the spot market. So right here, spot market, and then you can go and enter your orders. And what you'll be doing is actually buying and taking ownership of a cryptocurrency. We've got Bitcoin, US dollar Tether right here. So if you want to know how to get started with buying cryptos, I have other tutorials. I'll link them in the description for you. But essentially the spot market, as you can see here, we actually buy the underlying crypto asset. Now I'm going to switch back to the futures market right here. We're actually trading futures, which is a different product than a cryptocurrency itself. So firstly, a risk warning with futures. They are riskier potentially, especially if you're using leverage. Leverage is something that you can use with futures, and I'll go over exactly how and why traders would want to trade with some leverage, but certainly the risk increases substantially. This is definitely not financial advice, but just a general overview of how it works. So what are the advantages of actually trading futures of cryptocurrencies instead of the underlying asset and just buying and holding? Well, there are some. Firstly, you can actually go short, or you can bet that the price will fall. And this is something that you can't do when you're simply buying Bitcoin, for example. If you buy it, yes, you can sell it, but you can't sell more than you have. Well, with futures, you have two options. You can either go long, so betting on the price rising, or go short and actually bet on the price falling. But you don't require any assets, firstly, to go ahead and go long or go short. So you can just open a position to bet that the price will fall, and that is something that you can't do in the spot market. Other ways that traders will use futures is to hedge their portfolio. So for example, if they have a very large holding of Bitcoin itself and they're a long-term holder, they want to hodl for 10 years, but in the shorter term, they do see opportunities to trade around their portfolio. And so they may not want to touch their long-term positions, but they might use futures and try and trade around and take advantage of those short-term price opportunities. And you can do that with futures, something that is a little bit harder when actually trading in the spot market. Also, the fees are much lower for trading futures than in the spot market. You can actually come down here. We can see the fee level right here. There are two sets of fees. One is a taker fee and one is a maker fee. The maker fee, you'll be paying 0.02% as a trading fee. And then if you're a taker, you're paying a little bit more at 0.04%. What is a maker and a taker? A maker is someone that actually makes liquidity. In its simplest form, what a maker is someone that actually puts their order on the book and doesn't take someone else's order. So we'll go through the order book in a second, but right here, there are two types of people. There are people that take other people's orders. That is, if I look at these orders right here, these are people that are out on the book trying to sell some Bitcoin right here. And if I take their order, so if I go long and take their price, I'm a taker. If though I, for example, want to buy some Bitcoin or go long the future specifically, then I can come down here and actually make a price. I won't trade right now, but I can make a price. And so I get those maker fees instead of the taker fees. Of course, I have to wait until someone actually trades with me, but potentially my fees will be lower if I am a maker compared to a taker. To put the fee level in context right here, paying 0.02 or 0.04, both of these are lower than the spot trading fees at Binance, which is 0.075. So you do have lower fees when trading futures compared to the spot market. There are disadvantages, of course, with everything. With futures, definitely if you go long, so if you bet on the price rising, you want to go long, you do have to pay actually a funding fee because of the way futures works, and I'll explain that in a second. But essentially, if you go long, you will be paying shorts to go long. So you're actually paying to go long a little bit. You can see the funding fee here. It's a very, very small amount, but it is still there. And that's something that you don't have with just holding Bitcoin. You don't pay to hold it. But with futures, you do have to pay a funding fee if you're going long. Conversely, if you are selling short, you actually get this funding fee. So longs pay shorts. Also, we're going to talk about leverage, and you can actually leverage up your trades. You can come up to the top right here, press 1x. Yes, you can get a ridiculous amount of leverage. So you can actually be trading, let's just say 5 times what you actually have on account. Leverage increases risk substantially and is never recommended for anyone other than people that have been in the market a very long time. Again, this cannot be financial advice for you. I personally would never use leverage. It's just not needed for me, especially with a volatile market such as Bitcoin or any other crypto. But one of the disadvantages for sure is that with leverage, you can really get on the wrong side of a trade and basically just blow up your account. So that's something that we will talk about later on in the video when we come to some sample trades, potentially limiting your risk and understanding having a good risk profile when you trade. Also, a disadvantage of futures is that it's not good to use futures for the long term. Futures really are for short-term trades, trading around your portfolio. If you're a long-term hodler, it would obviously be better just to go and hold the asset because you wouldn't be paying these funding fees. So another disadvantage of futures, they have their uses, and it's mostly, in my opinion, for short-term trading around your portfolio where you may think the price is going one way and you can benefit from that day trade. Specifically with Binance, we can go through what all of these things mean, and it will be fairly similar no matter which platform that you're using. The information that traders need is really the same. So depending if you're using Binance futures or something else, you will get a lot of this same information. Firstly, we have the price in the market. This is, as you can see, Bitcoin against US dollar tether. This is the market that we'll be trading. So we have Bitcoin valued in US dollar tether. And remember, this is a synthetic contract that we'll be trading, simply enabling us to either go long or short, not hold the underlying. So we have the price in the market that obviously matches this one for one. We also have the mark price for the futures contract. So you can see the latest mark price is the price used for P&L and margin calculations. So this is important. If you are trading on margin and you're trading on leverage, this will be the price that is used to calculate all of those leverage positions. And of course, if you're getting down to a low amount of collateral on account, then you may face some margin calls, because essentially the way that you trade futures is putting some collateral on account and then going and trading usually larger positions than that. But you can also just trade with 1x leverage, which is no leverage, of course, and so this will become less relevant. We now know what the funding is and the countdown. This happens every 8 hours. And so what will happen every 8 hours is that this funding amount will be locked, and that is what the longs pay the shorts for the next 8 hours. So that will be the premium that you will pay to go long the future. As we go along, you can see the 24-hour change, just some price information here, not massively relevant. But on the right-hand side, we have the order book right here. So we have buyers or bidders down here, and then we have sellers or people that want to go short here. You can see a huge amount of movement in the price right here. But if we just zoom in, what we can see down here is that these prices are lower than the prices up at the top. People that want to sell at a certain price can post their order on the book up here, and people that want to go long or buy at a low price can post their bids right down here. When the price moves and matches, that is what this price is in here. So that will be an actual trade that's gone through. You can, of course, if you want to get your trade done straight away, put in a price that is, let's say, around here, and then that will go through straight away. But remember, you will be a taker because you're taking other people's orders. If you want to be a maker, simply choose a price that is below the mid price. Your order will come right down here, and then you'll wait for a seller to come and fill your order, hopefully at that lower price. But if you are going long, any orders down here will have to wait for someone else to trade at your price. If you're going short, any orders up here will have to wait for someone actually going long to take the opposite of your trade. I'll go through all of these orders and order types later on in the video, so it will become clearer then. Right down here, you can see trades. These are the actual trades that are going on and that have gone through. We can see the price, the amount, and the time that they all went through. If you have any open orders on the system, and we'll go through putting those in, they will be right down here. So you can see your positions, the symbol, obviously the currency pair that you're trading, the size of your position, and all the latest prices as well, including your profit and loss, specifically in Binance anyway, and most other futures trading venues. You can actually deposit a stablecoin, or basically a version of US dollar, in this case US dollar tether, or you can deposit Bitcoin. And of course, we're trading Bitcoin US dollar tether, so that makes sense. You can either deposit Bitcoin or USDT, and that will be used to fund your futures positions. If we actually change up here, so we can go and let's see if we can trade in Ethereum market. So we have Ethereum against the US dollar instead of Bitcoin. You can see that we now can deposit both USDT and Ethereum if we like. It depends which market that you want to trade. We'll go back to Bitcoin right here, and we can go for the Bitcoin US dollar perpetual future. What is a perpetual future then? A perpetual future is simply a synthetic contract that tracks the price of a currency pair, which is in this case Bitcoin and USDT. It is known as perpetual because the futures contract has no expiry date. In the financial world, a lot of futures contracts do have an expiry date because they are for commodities like corn or wheat, and so that contract between commodity brokers and traders has to be fulfilled at some point. But in this case, it's really just letting us trade the value of this currency pair, and perpetual means that there's no expiry date. So you don't have to worry about an expiry date. You can open your position and run it for as long as you like. Next, we can come to leverage. And like I said, leverage is extremely risky, and leveraging up your account also leverages up the amount of risk that you're taking and can basically blow up your entire account. But using leverage, you can see on the top right-hand corner, we're now at 1x leverage, which is obviously no leverage. So if you have $1,000 on account, you'll be able to trade open positions that are worth $1,000. And if you go to 5x or 10x, obviously that just means you can trade 7 times the value of the collateral that you have on account. You can deposit either USDT or BTC, like I said. Why would you want to use leverage? Well, leverage is something that occurs in currency markets in general, not cryptocurrency markets, but the normal currency market. People use leverage because the daily change between two currencies is extremely small. A currency pair like US dollar and pound sterling may only change 0.05% in a day. And so if you don't have a large amount of cash actually traded, it will be impossible to actually make any gains from that trading. With cryptocurrencies that can move 10 or more % in a day, leverage becomes extremely risky. But as an example, let's say you had $1,000 of USDT on account as collateral, and you open a position that is $1,000. So you open a position that is worth $1,000 of Bitcoin and you go long, but the trade moves against you and Bitcoin moves down 20%. What's going to happen to your position? Well, you're going to sell out and you're going to lose $200. You put $1,000 in, the price of Bitcoin went down 20%, 20% of 1,000, 1x leverage, which is no leverage, obviously is $200. You sell out at a loss and you lose $200. However, if you have $200 and you choose 5x leverage, that means that with your 200 USD on account, you can open a position worth $1,000. You open that same trade and you go long $1,000 worth of Bitcoin, and the same thing happens. The Bitcoin price falls 20%. 20% of 1,000 is 200. You have $200 on account. So with 5 times leverage, you've literally wiped out your entire portfolio. On the flip side, of course, if you're using leverage and it goes up, let's say you're using 1x leverage, you put $1,000 in and it goes up 20%, you make $200. If you're using 5 times leverage, so your $200 position opens a $1,000 position, it goes up 20%. Again, you make $200, but compared to your initial investment, you've literally doubled your money. That is how leverage works. It amplifies the upside and also the downside a lot, and potentially you could wipe out your entire portfolio if you're using leverage and the trade moves against you. Something else to be aware of on Binance and many other futures trading platforms as well is USDS futures versus coin futures. USDS futures simply means that you can put US dollar stablecoins on account for your collateral. Coin futures means that you can put the coin on account as collateral to fund your trades. To trade futures, then we can come over to the right hand side and we actually have a lot of different options that we can do. The first one is to either go long or short. So which way are you betting that the price will move? Right here, you can see it's an option that you can choose afterwards. So you can set up all of your trade parameters and then only choose whether you want to buy or sell, go long or go short. Let's try and become a maker of liquidity then, and we can put an order on the book. So right here, you can see the price 33,519. What you can do is click these prices and it will update the price right here, which is quite a quick way of getting an accurate price. I'm going to try and go long, but I don't want to pay these high prices. I want to get a lower price right here. So I'm going to click right here and then this updates for me, or you can just press last to here as well. That will fill in the last current price, but it's obviously going to be way closer to the actual price. So I'm just going to amend this right here and choose 33,500. Now you can see that my price right here, 33,500, is below the current market price. So that means my trade will not go through. My order is going to be placed on the book somewhere down here. It's actually quite a long way away. I'm about $70, $60 away from the trade right here, but that's fine. I can put that order in. Now I have to choose what size. So how much BTC do I want to trade or go long? So I can choose this. This slider bar right here is telling me how much of my collateral that I'm using. So I do have some USDT on account and I can use a portion of that, which does make things easier, or you can just go right here and then put in an amount like this. So I've got 0.5 of a Bitcoin, or you can just choose 0.05 BTC and it will tell you what the cost is right here. So this is how much collateral you need on account to actually go and trade, or just use 50%. My order then is going to be coming onto the order book down here. I can now choose just to go long. This is a limit order, by the way. So I'm clicking on limit. I can choose my price. I can choose the amount, and then I can just go long the order. What will happen is that my order will come down here onto the order book. It will not have gone through yet because I've got a limit order on, and my price, as you can see, is below the current market price. So I will not trade right now, but my order, my position will be here, and it will be waiting for a seller to actually come and match me. It's the exact opposite for sell, of course, but with a sell, if my limit price was 33,500, obviously I would go through because people right now are actually bidding 33,600. And if I'm a seller, my price is 33,500. I'll obviously go through and trade around this central price. I could of course amend this, so I can amend this price to 33,650 right this. So now my price is way above the market. I'll have to wait for someone to come in and actually go long and have the opposite of my trade, but I can just simply go and press sell short. That order will work, and when it's through, it'll be in my positions right here for me. Any open orders that haven't traded yet will be right here in your open orders. You can also trade a market order with futures, so you can switch over to market and you can see that the price disappears. With a market order, of course, you don't choose the price that you pay, you just choose the amount that you trade. So again, we can use the slider bar. I can choose the amount of collateral that I have to go and trade BTC, and I can either go long or short, but I cannot choose the price that I trade at. What will happen is that whatever price that is available for me to have at the time that I press the order, that is the price that I will trade at. Market orders are used when people want to trade very quickly in and out of a position. For example, if a trade's moving against you and you want to get out quickly, you might want to choose a market order, but usually limit orders are suggested because you can choose the price, and this means there's less potential of just getting a bad trade. Next up, I want to discuss putting a take profit on there and a stop loss on there. So essentially what we can do when we enter the trade is actually create a bracket. Right now, the price of BTC is around 33,500, and we can see that happening on the chart right here. Well, when you enter trades with futures, a lot of traders will set a level above and below the trade as a take profit and a stop loss. This essentially mitigates any risk and lets you know exactly what your risk position is before you actually enter into the trade. What's great with Binance Futures is you can actually just click this and then set that when you set your order. So then we can choose our limit order here, and I'm going to put in a price of 33,500. So again, below the price, and I want to choose around half of my collateral. What I can now do is set a take profit price. So a take profit price would be if I enter a long position at 33,500, obviously a take profit would mean that the price would be above my entry. That's if I'm going long, of course. I can choose any amount that I want. I can come onto the chart right here and say, here is my open position. So 33,500 is right here. And I want to take profit around this level at 34,500, for example. So take profit right here, 34,500. That means that if I get in at 33,500 and the price moves up 1,000, that is when the system will actually sell my position and close out my position for a profit. More importantly, I would suggest is the stop loss price. This will stop losses if the trade moves against you, and it's really important when trading futures because it tells us exactly what our risk position is. So once more, let's say I open a position at 33,500. What is my stop loss? I can actually set this at any price that I want. So just as an example, we can do 32,500, meaning that if the price falls by 1,000, then obviously the system will just sell my position at a loss and stop any further losses. Later on in the video, I will discuss ways that you can set your stop loss and also some risk management. We can use some technical indicators to actually show us where we should place our stop loss. So we can use that together with this option right here and actually manage our risk. Keeping on order types though, we can actually come to a stop limit or a stop market order. So I'm going to click right here and you can see stop limit and stop market. As we know, a market order is an order where you don't choose the price that you trade at, and a limit order is when you do choose the price that you pay. They are both similar orders. I'll click on stop limit to show you the example. So a stop limit is essentially a price where you tell the system that you want to enter an order. So rather than limit order, where you're telling the system, I want to do something at a certain price, you are entering your order on the system and that is there for you. With a stop limit, you actually don't enter an order onto the system, but you only do it when a certain price is marked onto the order book. You can actually choose this as mark or last. Last price would be the last traded price, and the mark price is the price that you can see up here. As we can see, it is slightly different. The mark price does not match the last traded price automatically. So you can either choose the last traded price or the mark price, it's up to you. But what we're doing now is actually telling the system only when the price, let's say we're going long, only when the price gets to 34,000, do I want to enter a long position. Well, why would you want to do this? Traders will use stop orders to enter into positions that limit orders otherwise can't fulfill. Let's say you're a buyer with a limit order. If I put my limit order as 34,000, of course, I'm telling the system that I'm willing to pay 34,000 to go long. The price currently is 33.6. And so what the system will do is actually just go ahead and trade my order straight away. It will get me probably a better price than my limit order because the actual price is trading below it, but it will definitely trade for me because my price is above the current price. With a stop limit, that isn't the case. You can tell the system only when the price hits 34,000, do I want to enter an order into the system? What price is that? You can actually choose whatever you want. You can choose exactly the same as the mark price. You can actually enter an order above. Remember, this is a limit order. So again, if your limit order is 35 and the stop price is 34, what happens is the system says, hey, the price is 34. You told me that you want to buy and go long at this price and your limit is 35. I'm going to go ahead and go long everything as long as it's under your limit price of 35. You will probably be traded around 34, so you'll get a better deal than your limit. But limit price, of course, is just the upper amount that you're willing to pay in terms of the price, and you may get a better deal than that. You can, of course, put in, for example, 33. So let's say the price actually goes to 34, and the system at 34 will put in a limit order for you at 33. You're not going to trade right now because your limit is 33 and the price in the market is 34, so you're too cheap. Why on earth would you want to do this? Well, a lot of traders will actually use stop limits with breakouts. So they will come to the chart and they will possibly see areas where the chart may break out, some important levels, and they don't want to enter a trade until it gets to a certain level where they may want to trade that breakout. So they can use a stop limit order and actually not put those orders into the system straight away, but they're only triggered when their stop price is triggered. Stop market, of course, just means that we don't choose the price that we pay. So we can put that in here. Let's say the stop price is 34,000. We will enter a market order, and remember, we don't choose the price. So when the price gets to 34, and let's say we want to go long right here, the system will enter that trade for us. So we can put, let's say, half of our collateral up. We can put some take profit and stop losses in that we want, but we're telling the system only when the price gets to 34 do I want to go long. Of course, now the price is 33.6. So why wouldn't you just want to go long at a cheaper price? Well, again, it's used for breakouts. A lot of traders will say, I'm not sure it's going to break out. Only when it does break out of a trend do I then want to go long. And they don't want to wait for that. So they will put these stop limit or stop market orders in. Another type of order that you may want to use is a trailing stop order. A trailing stop will follow your trade positively, but it will not follow your trade if the price moves against you. So again, I'm just going to use the example of going long. If you go long at a certain price, let's say 33,600, you can say, I want a stop loss around 5% away. What will happen then is a stop loss will be put in at 5% underneath your position. that will be an order in the system that says if I am losing 5%, then sell out and stop any further losses. If the price moves down, this will not move. It will not keep 5% away on the downside. It will stay exactly where it is, and it can be triggered 5% away from the activation price that you went in at. This can be 36,000, for example. So if the price is 36,000 moving down, that 5% will be 5% away, but it won't keep moving down. Conversely, to the upside, it will do. So let's say the price is actually moving up. This will essentially trail your price and be 5% away all of the time to the upside. If the price starts moving back down again, this trailing stop will not move. So to the downside on your trade, it won't move and it will trail to the upside. So potentially you could lock in profits if the price moves up a long way and then starts moving down again. It will basically lock in a profit for you. If you go short, of course, it will be the complete opposite way. So if the price moves down, it will follow because that is you winning if you go short. And if the price keeps moving up again, then it will obviously stop where it is and potentially trade out. Now that we know all the order types that we can use when trading, we can actually come to entering a trade. And with futures, you may want to look at your risk management before entering into your trade. One very common technique that traders will use to enter a stop loss position is something called the ATR. The ATR is an indicator. I'm going to come up to technical indicators right here, and I'm going to search for ATR, which is known as average true range. I'm going to click on this. Now what we have below is the ATR. The ATR essentially tells us how much is the biggest move that can happen in the asset that we're trading in the time period that we're looking at. So right now on my screen, you can see I'm looking at the 1 hour chart. I can change this and the ATR will change. The ATR is going to give us the biggest probable move of that asset within the time period. So at the moment, what it's telling me is that Bitcoin against US dollar tether, the largest possible move in 1 hour would be around 421 bucks. If I now change this to the 15-minute chart, what you should see is the ATR will reduce. Now the biggest move within 15 minutes is about $200. Of course, the price can move more given more time. If I reduce the time further, so I come down to a 1 minute chart, the price can't really move too much within 1 minute. So you can see the ATR is around $50. This is actually really important in terms of risk management. The longer time frame that you're trading, the higher probability that the price can move or fluctuate a larger amount. If you're trading very short timescales like 1 minute, the price isn't going to move much. If you want to limit your risk, then you may want to choose trading shorter timescales because the amount the price can move is smaller, and so potentially you can start trading with a little bit of a lower risk. Let's go back to the 1 hour chart then, and we can see the ATR change. The highest probable move within 1 hour is around $400. It's also important to understand how much of your portfolio or your collateral that you should trade at any given time. Most traders would suggest that around 2% of your portfolio should be at risk. Of course, you don't want to trade the whole lot at once and have all of your position traded all of the time. But we can come to a lot size calculator. Cashback Forex does a good one. So you can see the currency pair that we're trading is Bitcoin USD, and the deposit currency, so that's our collateral. Let's say we will have deposited US dollar tether as that US dollar stablecoin. Let's say also that we want to go long. So we want to enter a position at around 33,500 to make it easy. So our open price is 33,500, and our stop loss price, well, we already know our stop loss because maybe we can choose the ATR as our stop loss, telling us that the highest probable move within 1 hour is around $450. There are other ways to set stop losses. Of course, you can look at different levels in the chart, areas of support and resistance. I have many other tutorials on how to look for support and resistance. I'll leave all of them linked in the description for you. But just as a guide to show you how, we can put our stop loss in then at $450 away from our entry. So our stop loss would be 33,050. So that's 33,050. So that's our open price minus our stop loss right here. And we have $10,000 on account for our collateral. We only want to risk 2% of our portfolio per trade. We can calculate this now. What this tells us essentially is the trade size that we can execute. To have a balance of 10,000 and a stop loss of $450 to risk 2%, we're obviously risking 200 bucks. How do we know how many units we can trade? Well, it tells us right here, we can trade 0.44 of a Bitcoin, and that will only risk us 2% of our portfolio with our stop loss at 450. So we can come back right here. We can then go onto our trade. So we know exactly how many we can trade right now. So we can go long at 33,500 and we know we can trade 0.44. With this risk management strategy, then you can really use this on any type of trading strategy that you want. I do have many other trading strategy videos that take you through technical analysis and also some common methods that traders will use to enter into trades and get trading ideas. I'll link all of those in the description for you so you can learn more about those if you wish. If you don't have a Binance account yet, I will leave that link in the description if you want to go ahead and trade futures. Do subscribe for daily helpful crypto content, and I'll see you in the next one.